Here's what millionaires know about asset location that you don't. Most people spend a ton of time thinking about what to invest in: stocks versus bonds, real estate versus mutual funds, ETFs versus individual securities. But what if I told you that the location of these investments, not just the investment itself, could be the difference between you retiring comfortably and you leaving thousands of dollars on the table each and every year? Millionaires know this, most everyday investors don't. In this video, I'm going to show you how to optimize for asset location, the strategy of placing the right investments in the right type of accounts to lower your tax bill, improve your after-tax returns, and build long-term wealth more efficiently. And before we dive in, my name's Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. So we're going to start with a pretty simple idea. Not all investment accounts are taxed the same. You have three basic types of accounts. First is your taxable account. This is sometimes referred to as a brokerage account. Next is your tax-deferred account. These are things like your traditional IRA and your traditional 401k. And finally, the last one is your tax-free account, which would be the equivalent of anything that is a Roth account. Each of these has its own set of tax rules. And when you understand how they work, you can align your investment strategy with your tax strategy. So what we're going to do is we're going to break down each of these different types of vehicles and talk about what types of investments should go inside of them to help maximize for asset location. So first, we're going to talk about your taxable accounts. And this includes your regular brokerage accounts at places like Fidelity, Schwab, or Robinhood. These accounts are very flexible. You can buy and sell whatever you want, whenever you want, and there's no contribution limits or distribution requirements like there are in qualified accounts. But there is a catch. Any interest, dividends, or capital gains realized are taxed in the year in which they're recognized. So if you hold investments that kick off a lot of income, like bonds or real estate investment trusts, you could owe a lot of taxes every single year. That's why taxable brokerage accounts are best suited for tax-efficient investments, like stocks or index funds with a low turnover ratio, especially when you hold those investments for the long term, which will benefit from favorable capital gains tax treatment. And if you're a bit more on the conservative side and looking for bonds to put inside of a taxable brokerage account, you might want to consider municipal bonds because they tend to pay tax-free dividends. You just need to make sure that you are buying municipals in the state and county or city in which you live in order to reap the entire reward. So with municipal bonds, you also want to compare it to the after-tax yield of a bond that is not tax exempt. So for instance, let's say you're in the 35% tax bracket and your state tax rate is 5%. If your pre-tax rate on a bond that is taxable is 6%, its after-tax return is 3.6%. If you can find a similarly rated municipal bond that pays a higher tax-free rate than that, it may be something you want to incorporate in your portfolio. And one last thing to be aware of inside of brokerage accounts is capital gains distributions from mutual funds. Some investors realize taxable gains without even trading a dime. And the reason for this is because if they invest in a mutual fund managers must trade the fund throughout the course of the year to meet capital call requirements from its other investors. And sometimes this realizes gains as a function of that process. And as a shareholder of that mutual fund, your pro rata share of those gains are passed through to you as phantom income in the year in which it happens. So you may get a capital gains distribution even though you did no trade in your account because of what the fund manager had to do to fulfill their job requirements. So next are your tax-deferred accounts. This is where your traditional IRAs, 401ks, and similar retirement accounts come in. You don't pay taxes on the contributions. That money will grow tax-deferred. And then when you distribute these funds in retirement, you're going to pay ordinary income tax on these distributions. And because of that, you want to be thoughtful about what you put in here. A smart move would be to put your most tax-inefficient investments inside of a tax-deferred account, like taxable bonds or real estate investment trusts. That way you can avoid paying annual taxes on their income while you're working. Yes, you'll eventually pay tax on the withdrawal, but ideally, it's in retirement when your income is much, much lower, and you don't have to worry about it adding to your income during your working years. You also want to tend to mirror your overall portfolio in this type of an account. If overall you're an 80-20 investor, like what I would consider a growth investor, it would make sense to be in the same or a similar allocation in this type of an account. This will likely be your largest bucket of money. Having a well-diversified approach can pay dividends. And not just any dividends, in this case, they're tax-deferred dividends. Finally, we're going to talk about the tax-free accounts or your Roth accounts. You contribute after-tax dollars to these accounts, but once the money's in there, it grows tax-free and can be distributed tax-free in retirement, assuming you meet some of the basic criteria. This is prime real estate for your highest growth potential investments. Why? Because you want those tax deferred dollars compounding as much as possible. Small cap stocks, emerging markets, tech ETFs, anything that could generate large gains over time, Roth is where you want it. Let's run a simple example. Imagine you have $100,000 in a fund that averages 10% a year for 20 years. That'll grow to about $672,000 at the end of those 20 years. If it's in a Roth, you get that full $672,000 tax free. If it's in a traditional IRA and you're at a blended tax rate of 25%, well, you're going to owe about $168,000 in taxes on that investment when you pull that money out. And if it's in a taxable account, you'll pay taxes along the way, which reduces the compounding and capital gains when you sell. That's the same exact investment in three different types of accounts with three very different results. For these reasons, I recommend that clients take the most risk in their Roths. It allows them to reap rewards in up markets, and because it is likely the last bucket of money they'll touch, it has a long time horizon to wait out down markets. Now, if all you have is Roth money, you need to live on that money now, taking some of the risk off of the table is probably worth it. The extra 1% to 2% annual return is not worth a pullback of a bear market exposed to a 100% stock portfolio in a Roth. So if you find that you have an over concentration in Roth, or maybe even your entire portfolio in Roth, maybe you want to dial back risk a little bit in order to meet your monthly obligations now, but continue to take sensible risk with the more long-term portion of that money. So now that we've properly defined all three types of accounts, let's talk about the asset allocation strategy itself. And this isn't about changing what you invest in, it's about where you put those investments to make your portfolio more tax efficient. And I know we talked a bit about this already, but here's a general rule of thumb. Bonds and REITs should go in your tax-deferred accounts. Stocks and equity index funds should go in your taxable accounts. And high-growth assets, well, you want those in your Roths to reap the reward of compounding over time. But let's break this down a little bit more. So why would you want bonds in your tax-deferred accounts? Well, mainly because bond income is taxed as ordinary income, just like wages. It doesn't qualify for long-term capital gains or qualified dividend treatment. So you want to keep it shielded from annual taxation while you're working. Same goes for REITs, real estate investment trusts. They tend to throw off high yields, but that income is often taxed at your highest rate again. So again, keep that in your traditional IRA or 401k. And just as a caveat, you generally want to stay away from municipals in your tax-deferred accounts. The IRA already has a tax shelter around it, so you'd be wise to take the higher yielding corporate bond equivalent as opposed to the tax-free equivalent, which is better suited in your taxable brokerage account. So why would you want stocks in taxable accounts? Because if you hold individual stocks or index ETFs, you might not realize any gains until you sell. And even when you do, long-term capital gains tax rates are 0, 15, or 20% depending on your taxable income, which is much lower than your ordinary income tax rate would be. Plus, in a taxable account, you can take advantage of tax loss harvesting, which is selling losing positions to offset gains or even regular income elsewhere in your portfolio. And if you hold these stocks until death, your heirs receive a step up in cost basis, meaning they could sell without paying any capital gains tax at all. So let's walk through an example where you bought $10,000 worth of Apple stock, and during your lifetime, it grew to $100,000 and then you passed away. Well, your heir or your kids or nieces or nephews or a charity in this instance would get that $100,000 of Apple stock, and their new cost basis would be what it was on the day of your death, or the $100,000. So you can turn around and immediately liquidate this with no capital gains tax implications, where it would have cost you somewhere in the ballpark of $10,000 to liquidate that position had you done it yourself while living. None of these benefits exist inside of an IRA. And when used strategically, investors can mitigate their tax liability or completely eliminate it through strategic distributions. Finally, why would you want high growth positions in your Roth account? Well, because this is the one account where if you follow the rules, you're never going to pay taxes on that money ever again. So the bigger it grows, the more valuable it becomes. This is why many wealthy investors allocate their most aggressive investments inside of Roths, things like small cap stocks, early stage ETFs, or even private placements. They want all of that upside with none of that tax drag. A Roth account you have a long-term time horizon and no current need for distributions from is one of the greatest advantages an investor can have in their arsenal. Now, here's where a lot of people get tripped up. They focus only on asset allocation, not asset location. Asset allocation is what you invest in, how much you put in stocks versus bonds versus REITs versus cash, etc. Asset location is where you hold those assets, and that decision can improve your after tax returns without taking on any additional risk. In fact, studies show that a properly executed asset location strategy can improve your after tax returns by 0.3 to 0.75% annually, sometimes even more. That might not sound like much, but over a 30-year retirement, it could mean tens or even hundreds of thousands of extra dollars in wealth just from being smarter about where you put your money. Couple that with a direct indexing and tax loss harvesting strategy, and you can generate even more excess return when you maximize for asset location. So let me leave you with three key takeaways. First is you need to look at your portfolio as a whole across all of the different types of accounts. Don't manage your Roth in isolation from your IRA or your brokerage account. Think holistically and then maximize location and risk by account type. Second, asset location is most powerful when combined with tax planning. Roth conversions, tax loss harvesting, withdrawal sequencing, it all works better when it's coordinated. Finally, there's no one size fits all answer. Your income, tax bracket, goals, and withdrawal strategy all matter. What's ideal for one person might be inefficient for another. That's why the strategy works best when it's customized for you individually. At NavWealth Partners, this is exactly what we help our clients do. We combine investment management, tax planning, and long-term strategies to not only grow your wealth, but to help you keep more of it. If you want help building your own asset location strategy around your portfolio, please reach out. You don't have to figure this out alone. Thanks for watching, and as always, let's make some smart money decisions.